there, this is James, and you're watching Tixee Live. In fact, you're watching Tixee Live presents hashtag Ask James. Now, this is the video series where you send in your topic or your subject you wish us to do a video on, and then we dedicate a whole live episode just for that topic. Now, before we get into today's topic, and a special shout out and thanks to the individual who recommended or requested this topic, don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. With that out of the way, let's get started. So like I said, this is Tixee Live presents hashtag Ask James. And today's topic is something which I do a fair bit of when I'm doing my normal Tixee Live market videos every day. And that is an introduction to trading with multiple timeframes. Okay, multiple timeframes. Because I tend to find that, or discover that people who are new to trading, they tend to get married to one time frame. I think that's the only one to use. I wanted to introduce how using multiple timeframes can really assist you with your trading. Now, this obviously is a big shout out to Geezerman18. Love the name, Geezerman18, for this suggestion or for this request of this topic. So big thank you to you. But anyway, let's get on with it. So first of all, what is multiple timeframe analysis? Well, multiple timeframe analysis. Okay, this actually is what we're going to go through today. Should I start off at beginning before on this topic? This is what we're going to go through this little video today. What is multiple time frame analysis? What are the different time frames? Using multiple time frames to identify potential support and resistance levels. How to trade with multiple time frames, and ask the question: what time frame may be best for you? So anyway, let's get started. So first of all, what is multiple time frames? Well, multiple time frames, or multiple time frame analysis, should I say, involves the trader to monitor the same currency pair, but across different time periods. Now, as you know, there's many different time frames, ranging from 1 minute, 5 minute, 15 minute, 30 minute, 1 hour, 4 hour, daily, weekly, and even monthly. Okay, even monthly. Now, there is many benefits, obviously, to multiple time frames, which we'll go through. Now, the main reason why I think there is so many time frames available is obviously that trading is, at the end of the day, is personal. Okay, so traders can have different opinions on how the pair is trading, same as they have different trading styles, and a certain time frame may complement that certain trading style. For example, hey, hello there, hello, Mr. Clan. Thank you. I hope you're good. I hope you're well, and thank you for coming along. Hope you're doing great, sir. Hope you're doing great. But so yeah, like I say, so it does tend to be dependent on their trading style. And this is again what we'll talk about near the end of the video. And here's the thing, because we all have our different trading opinions. One trader could see a pair on a downtrend on a 4-hour chart, okay, and the other trader could see the pair ranging on a 15-minute chart. Now, here's the thing: both of them could be correct in that time frame. So again, the benefit of using multiple time frames, and we'll go through some of the benefits in a minute, is it can give you a better overall picture. Okay. Now, these are some of the benefits. Oh, I'm getting trolled again. No, I'm okay, thank you. I've got a girlfriend, but thank you for coming. It's just a bot in it. But anyway, always makes me laugh. Anyway, so here's some of the benefits of looking at multiple timeframes. Okay, number one, it gives you a different perspective and view of a currency pair or of an asset. It can assist you to spot potential support and resistance levels, or more importantly, reaffirm how strong that potential support and resistance level is. Number three, can help you spot potential trend changes as well. Number four, can help you identify potential entry and exit levels. Number five, help with trend confirmation. That's always an important one. Helps you with trend confirmation. Number 6, can help you see the small picture, the medium picture, and the larger picture of an asset. Larger picture of an asset. So let's go through the different time frames. So understand. So we can try and sort of fit into, you can ask yourself the question as well, what type of trader am I and where does this fit in with my trading needs? So let's have a quick look at some of them. Now, first of all, we have pretty much what you call like a long-term time frame. Okay. People who are long-term time frames, they look at charts of say 4 hours, daily, weekly, and monthly. These are more frequently used by position traders. You are long-term traders. Now, the advantages to losing long-term or being a position trader is A, you don't have to watch the charts frequently. You're not completely looking at the chart every 10 seconds or every day. You don't have to constantly look at it. There are fewer trades. Okay, so there's less, obviously, trading for you to do or less activity you need to do because there's less trades because it's longer term. You have more time as well to think your trade through. You're not in a rush. You're not suffering from fear of missing out so much because you're not then sort of being, seduced by a fast-moving candlestick or fast-moving chart, are you? You've got a bit more time to think it through and make a more grounded, potentially more grounded trading decision. Not necessarily all the time, obviously. It doesn't, but you know what I'm saying. Disadvantages. Patience is required. You need to take your time and you need to be a patient individual because the whole point of being a position trader is you're in the market for a long period of time. So you're not instantly going to be in the green. It's going to take a while for that position to end up being profitable. And for that very own reason, quite often with long-term time frame analysis or long-term trader, you need a bigger account. That might need a bigger account because you know what the market's like. The market can swing very dramatically, which means if you're holding your trade for a long time, you're going to have to put up with the fact that quite maybe the majority of the time before it goes to the direction you think it will go, you're going to be in a negative for a while. So you might need a bigger account to be able to hold positions. And like I say, you then also, because it's long term, you may also at the same time be looking at a negative balance on your account for a while. You're counting a loss before it actually goes to the direction you think it is. So that's sort of long-term time frame analysis. Short-term traders, okay, or short-term, or actually medium-term, shall I say? Medium time frame, okay. These traders tends to look at 30-minute charts, 1 hour chart, 4 hour chart, and daily. These are often used by what's called as swing traders who hold their positions sometimes for hours, but maybe up to a week. Okay. The advantages of obviously looking at medium-term charts is there's potentially more trading opportunities. Okay, because you're looking at the medium term. You tend to open a lot more trades as a swing trader as well. Plus, there'd be less months of where you're holding a position and your account is in a loss. The disadvantages, obviously, is there's a lot of potential of overnight risk as well. There's going to be more transaction costs because you're most likely going to be opening more positions and more, spreads of things to be paid. Whereas a position trader or a long-term trader, you open a few trades and hold it. And as well as that, you're going to have to be a bit more committed to keeping up to date with your charts as well. So you frequently need to be looking at them. Frequently be keeping up to date. I like a long-term trader. You don't need to keep on top of it so much. And there's something else. There's the other one as well. Short-term time frame. Now, these individual traders, they tend to look at their charts for, say, 1 minute, 5 minutes, 10 minutes, 15 minutes, 30 minutes, 1 hour. Now, those individuals that tend to look at these sort of time frame charts are used by intraday traders or very short-term scalpers who do not intend to stay in the market for longer than a day at the most. There may be even less than a day, but definitely no longer than a day. That's why it's called intraday trading. Now, the advantages of this group or advantages of this type of time frame analysis, okay, is there's lots of potential trading opportunities because you can be looking at it a lot more. So a lot more trading opportunities, less months of an account being in the negative, and less overnight risk. Okay, less overnight risk because you're closing your position by the end of the day. The disadvantages to this time frame analysis is there's higher transaction costs as there is a lot more trades. Mentally, it's more difficult as you have to be ready to change your opinion frequently. So you have to get ready to change your trading bias straight away. Now, I could turn on the hat because that's how the market can move. And charts are your life. You will have to be obsessed with your charts. You have to be continuously looking at your charts. The difference, obviously, the other disadvantage is because you're not holding it for long and you're getting out by the end of the day, potentially there's smaller profits as all trades are closed by the end of the day. The idea of certainly with scalping and this type of trading is because obviously it's closed by the end of the day, or at least by the end of the day, there's a lot more trades as well. So that's something you need to bear in mind. So using, I mean, this is the thing, this is what I want to talk about, and I'll go through some illustrations now. Using multiple timeframes to identify potential support and resistance levels. I tend to look at it this way, as it determines to me how strong a potential level is, or how strong a potential resistance or support is by looking over several timeframes. So let's go through some examples. Okay, let's pull up one of the assets. Let's have a look. For example, let's start off with, I'll tell you what, let's start off with, say, not that one. Okay, let's have a look at, say, the euro dollar. Nice little spike down on the 15-minute there. Okay, so let's put in some moving averages as well. Let's put in a 50 and a 200. So let's put a 50-day moving average and a 200. Okay, interesting. Okay, and then let's put in a 200-day moving average as well. Oh, I forgot to change the color. That's not going to help, is it? Let's try that again. There we go. Delete. Let's try this again. Let's put a 200-day in. Let's make it a nice, pretty red color. Right. Okay. So there's our 200. All right. Okay. So we can see this is on a 15-minute. Okay. That it's been hovering around this on the 15 minutes. Okay. So that's potentially a support level. So that's around 1055.95. Okay. Let's have a look at on a 30-minute. Again. Right. Okay. Slightly not quite the one. It's actually, in fact, that's acting as a support on the 30-minute. Okay. So let's look at an hour again and acting as a support. So this 50-minute moving average, short-term trade, maybe for very, very quick trade there, but it's not a strong enough or keen resistance to us. So let's have a look on a bigger picture. Ah, right. Now we recognize something a bit bigger. We can see the overall trend at the moment, as it's above the $200 moving average, okay, is 1.03382. Though it's trading at 1.54 on a longer picture, okay, there's a key area there at 1.6016. So had we acted on roundabout thinking this could be a potential resistance, by looking at it a bit slightly longer time period, we can see, yeah, there is a little bit on a smaller scale, but there is a big chance that obviously that could break because we can see a stronger area of interest in a bigger picture. Let's think of something else. Let's have a look at a different asset as well. Let's have a look at, the sterling. Okay. Right. Let's start off with, say, 15 minutes again. Right. Okay. We have got an uptrend on the 15 minutes. We're both above the simple moving average and the 200-day moving average. But let's have a look again. Let's have a look at this, say, 1 hour. Okay, still fair enough. What was our potential area of support on the 15 minutes? It's 12265. So let's put that in and we get rid of the line in a minute. So 122561. Let's have a look, see where that is on the 30 minutes. Whoa. Way above that. So we actually have a look here on a 30 minutes, we can see some previous history where this acted as a resistance. So potentially this area may provide us a slightly more stronger support area. So maybe you have to keep an eye on that. Let's have a look on a daily as well. Daily wise. Daily straight away. On a daily, we know 12244 is the key area we're looking for, because that's obviously a lot stronger. And it's actually had 1, 2, 3, 4. It's had 5 trading sessions where it's been holding. So although we are looking at a smaller term now, we can see the overall picture on a longer term. And let's say, look, we can even go all the way back to the 19th of August, where it also held as resistance. So we're looking at a bigger picture. So it gives us a teeny weeny bit more confidence that that resistance is more key. So that's something about that. So how to use multiple timeframes? How to use multiple timeframes? Okay, this is some of the, again, we just did it just then in some ways, but realistically, how many timeframes do you use, or should you use? Okay, in the ideal world, you don't want to do overkill. Okay, you don't want to get yourself so flabbergasted where you've got so many different time frames happening and you're going through the through, because as you can see, even on my chart again, we've got 1 minute, 5 minute, 50 minute, 30 minute, 1 hour, 4 hour. So there's so many there to look at. Okay, so you don't really want to get yourself confused with too many. Ideally, you choose 3, and this is how you choose 3. First of all, you use 1 to determine the trend, the overall picture of the market. And to look at the overall trend, you don't look at 15 minute, you don't look at 30, you look at daily and weekly. So that way you can then identify what the overall trend of that asset is. Like I say, if we give you an example here, again, I'll bring the euro dollar back up. Okay, we can see that in general, we are generally on an uptrend a little bit for the time being. I'm not saying that the euro is going to be always there. Generally on the uptrend, we can actually draw our trend line in there. So we know we're generally on the trend line, plus we're above the 200-day moving average. So again, gives us the overall picture of it, where the trend's heading on this. Then 2, you determine the market bias. Okay, determine the market bias. So then what you then do is you then maybe go to a 4-hour chart. So look at it a little bit closer to see where there's a potential entry level. Okay, so again, if we go back to my chart again, here's a 4-hour chart. So now we've zoomed in a bit closer. I mean, that trend line which we put on a daily is still there, which is good. We know the area of interest on the daily as well, but we're also looking at potential, where the potential entry is as well. And then, of course, we go a little bit closer. So let's go a bit closer and see if we can get a better picture, see if we can get a clearer view of where the entry or exit level could potentially better be. So we look at 1 minute, right? So 1 hour, sorry. So here, round here, the simple moving average, and there is where potentially the potential entry level could be. So again, it's given us a clearer picture. So like I say, using 3. Hey, good to see you. Hope you're well. Hope you're having a great day. I hope you're well and you're doing well, my friend. Good to see you. I like this topic because I use multiple timeframes a lot. But like I say, it's best to maybe use 3. But what 3? Because again, there's no set rule for this. I mean, there's lots of different gangs. I mean, again, if you're looking like short term, like you're in and out of the market, you might want to use a 1 minute, 5 minute, and 30 minute. Or maybe slightly longer in the market, 5 minute, 30 minute, 4 hours. Or again, 30 minute, 1 hour, 4 hour. Or maybe a bit longer, 1 hour, 4 hour daily. I mean, that's how I tend to, because that's what works for me. Or again, if you're a position trader, which I often am, 4 hour daily, weekly. So again, you play with the different groups. But if you try and keep it to 3 only, then that you're not getting overkill with it. So you're not getting over the top with it. And then a simple question, which I get asked all the time: what is the best time frame for you? I mean, what's the best time frame? There is no set rule of what is the best time frame. It all really depends on your personality and your trading style. Again, like I say, trading, like I often say on my little programs, trading is personal and it needs to fit your personality. Okay. If you're someone patient with a long-term view, like I often have, then I'm a position trader. So that means I look at, 4-hour daily and weekly. And that's how I look at my positions. And sometimes occasionally I do swing. When I look at swing trading, I sometimes for 30 minutes, 1 hour, 4 hour again. So that's what I tend to look if I'm a swing trader as well. So it does all depend on your own personal bias to trading. And, like I say, importantly, try and stick to only 3 time frames. Don't overkill it because it gets over the top complicated. And here's the other thing as well. Just because one person uses these 3 time frames doesn't mean you have to. Practice with several time frames. See what works for you. Practice with it. Absolutely, practice with it and see how it goes. I'm going to give you one more example. Okay, again, I've always been talking about this. Always talked about this. Okay, we've had a reasonable movement with gold. Actually, we've had some news that's come out as well. Actually, it's the PPI, isn't it? And that's what sparked the market. Sorry, I'm digressing. I just want to see what the news event was. What was the number? I mean, like a mini watch along. Like a mini watch along. Okay, 1 second. I have to take this out and I'll put this level back in a minute so we can show you my example. Okay. Sorry, folks. I just got obsessed. I just forgot to remember about the PPI. Okay. Right. Yeah, sorry, the PPI just came in. It came in slightly higher than anticipated. This is why we've seen a sudden movement in the market. It was expected to come in month for month, 0.2 came in 0.3. Core came in 0.4, a lot higher than anticipated, 0.2. So year on year, 6.2. So higher inflation. So this is why we're seeing a sudden spike. This is probably why. Anyway, sorry, I'm digressing. Let me give you one more example, okay? Of how I look at the time frames. And those of you, for example, know me, I'm a gold bug. Okay, and I've taken that level out, which I've been looking at for a long time. Now, obviously, we've had a big movement in the market. Okay, so this news is broken, and we're thinking, right, where's resistance could be on the 30-minute? We don't see that. So let's have a look, see where the key resistance is. Those of you who've watched my programs regularly know very well. I've been watching this area around here very, very, very closely. Very closely. So I'm on a 30-minute chart. Okay. I haven't put that line in. So I think, okay, where is the top on this? Where could it go? And then I'll have a quick look at the daily, which I have been looking, and I've been watching this level for a long time. Put it in my daily and I go, right, on the 30-minute. Oh, okay, let's have a look. Yeah, that was a potential level of resistance, which again has kept it down. So that's why it's dropped off from that level. So again, it's giving me a bigger picture. If I didn't have that in on my daily and I just watching on the 30-minute, I wouldn't see where the potential resistance would be. By me going to the daily and looking at the daily, because I've put it in for a while, I've been watching that level for a while, so I know exactly where it was. Put it back in, I can now see on the 30-minute, I know where the key area is or key potential resistance is. So that again helps. Yeah, so like I say, practice with several as well. Bear in mind and find which fits your needs, because like I said before, and like I say many times, trading at the end of the day is personal, and it's all down to your own personal characteristic, the amount of time you can put aside to go into trading, and the way you view things. Your personality. Are you excitable? Are you calm? Are you patient? There's so much more to it. And I will probably do an episode on the different types of traders so you can try and identify what type of trader you are. Don't forget, you can ask me questions anytime at all, or, share your opinions Did you find it interesting? Did you like this subject? I mean, is anything you want me to go around? Don't forget, when I do the hashtag Ask James episodes, they're more of a shorter introduction. This is why it's always called introduction. When I do the trading school episodes, which is on a Wednesday night, I go into the topics a lot more detail with my colleague, because it's a show which I do with my fellow market junkie, Stefanos. So we go into a lot more detail, and it goes on for a lot longer. These are like little bite-sized pieces, if you know what I mean, just like an introduction to introduce the topic to you. So bear that in mind. By the way, if anybody wants to, come on chat and let me know what topic you want me to do next. Is there any topic in particular you want me to do next? Any particular area you may be interested in, you want me to do? Don't forget, you always have that option as well. The other option you have, of course, at the same time, if you think of a topic or you think of a question even later, you could put it in the comment section, either on YouTube or Facebook. I will see them and I will reply to them next time I go live on air, which of course will be, the next hashtag will be not next week, but the following week, because next week we've got a watch on of the US CPI, but we will be doing a hashtag the following week. So you've got plenty of time to get your topics in as well. So, bear that in mind. And like I say, if you have a question as well, put it on it and I will answer it, because I will see them. I will answer them next time I go live on air. So bear that in mind as well. Okie doke. If there is no questions or no requests, not a problem. Not a problem. Okay. Don't forget, if you're watching me on Facebook and you enjoyed this little video, by all means, give us a follow. If you're watching me on YouTube and you enjoyed this little video, subscribe if you like. Hit the notification button so you know next time when I'm going live. If you enjoyed this video, found it interesting, useful, and you sort of put up with me, by all means, give me one of these. It's nice to know that you like what I do. Before I go, and before I sign off, big shout out to Geezerman 18 for this brilliant suggestion, this topic suggestion. Really, really appreciate it. Please keep the suggestions coming in. So big shout out to Geezerman. Big shout out as well to Forex Clan and Next Step for saying hi and saying hello. Really appreciate that. It's really nice. And a big shout out to all of you who've taken the time out to come and watch me today and join me today. I really, really, really appreciate it. Anywho, till next time. Don't forget, these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence. And of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.